Welcome back, everyone, to the Joseph Carlson Show. In this episode, we're going to be talking about two companies, Estee Lauder and Starbucks, both of which have fallen a lot after hours. Let's go ahead and look at the current numbers. Right now, Starbucks is down big, down 9% after hours. 9% or $10 per share. So it went from 115 yesterday before earnings, then it reported earnings yesterday after close. Now it's down 9% after hours. Now, we have a note here from Qualtrim that says Starbucks shares are trading lower after the company reported Q2 financial results. So it's after the earnings, but the interesting thing is it doesn't say the earnings were bad. Nowhere in the note does it say that the earnings were terrible. So we're going to dig in to Starbucks and see why this company's trading down and what I personally plan on doing, because I do own a little Starbucks in my portfolio. If we go to the restaurant category, I have much bigger holdings than Starbucks. I have Texas Roadhouse, which is a very large holding. Then I have Starbucks, which I have a couple $1,000s in, $3,700. So it's a meaningful position, not a huge one. It's been a good position, and it's a company that I really like. So we're going to be looking at this one. But then we also have another company that's really taken a nosedive. That is Estee Lauder, the beauty juggernaut. Now, there's L'Oreal, and then there's Estee Lauder. Those are the two duopoly of this category, a little bit like Coca-Cola and Pepsi. And then there's a bunch of smaller players. Estee Lauder reported their earnings, and it's down 15% currently. It was down 20% earlier today, so there's some dip buying going on right now. There's some algo trading going on, but it's still down 15%. It says that Estee Lauder shares are trading lower, and the company reported worse than expected Q3 adjusted earnings per share results, issued financial 23 adjusted EPS guidance below estimates, and said it sees further financial year 23 sales going down 10 to 12%. See, this is a note where we have a lot of gloomy news here. The company's trading lower because of earnings miss and guidance going lower. But we're going to look into this. Like I said, in many cases, when I look at this trading after hours of a company dropping 9% or 15%, this is the immediate reaction of the market. And the market, I think, in many cases, acts incredibly emotional. We saw that with Netflix. Netflix traded down 10% on decent earnings, really good cash flow, and then it immediately went back up 10%. So the company was flat after earnings. The people that were selling out of it right away were doing so either through algos or through emotions. So that's what I want to get to the bottom of. Are these trade downs, are these dips worth buying? Is this the market acting irrationally? Or is it being efficiently priced here? And these companies really deserve to be trading down. So we'll be going over the buy the dip opportunity here, as well as we're going to be looking at this through fresh eyes. I'm going to be doing analysis on these two companies. So let's go ahead and jump in. And if you like this type of content, by the way, you can always subscribe to the channel for free. We have almost reached 80,000 subscribers on a brand new channel. This feels so fresh, and I appreciate all of you that are supporting the channel that way. You can subscribe for free. If you want to upgrade your support, by the way, and get a lot of value in the process, you can join the Patreon, which includes Qualtrim. We just released the new version of it, and I think it's beautiful. It has a lot of additional tools and features, and we're adding more to it constantly. It's got the dark mode here. So if you want to try that out, $10 a month, comes with a free 1-month trial. So you can really try it out and see if you like it first. Now let's go ahead and jump into this news. And we'll start off with the big news here, which is Estee Lauder. Estee Lauder reported their earnings this morning, and immediately after the earnings report came out, the stock dropped 20%. Now I always say that it's not that instructive to look at how the stock is trading immediately after earnings. You shouldn't have that fill in your sentiment of what the earnings were, because in many cases, stocks drop after posting great earnings. And in many cases, stocks go up after posting weak earnings. It's all about expectations. And then there's a lot of other things at play, like robo-investing. There's lots of bots in the market, algos. There's lots of short-term traders that have options on it. There's a lot of noise in the market that can affect these prices immediately after earnings. Having said that, when a company the size of Estee Lauder drops 20% in a single day, that is substantial. We're talking about an $87 billion market cap company here. $87 billion dropping 20% in a day is substantial. And most of the time when I see this happen, it is a thesis change for the company. An entire point of view, investor sentiment, and thesis change. For example, when Intel basically said that they're losing a lot of customers, they are not gaining as much revenue, and they're cutting their dividend. Massive thesis change. The stock dropped over 20%. When we have Netflix. A year ago, they lost subscribers for the first time ever. That really crushed the spirits of investors. It completely changed their point of view on the company. The company dropped over 20%. Then we have Chegg, the online tutoring platform, aka the cheating platform. That company ran into trouble when ChatGPT was released. It took a lot of their market share. ChatGPT is eating away their business. And once that became apparent in their last quarter, it was a groundbreaking thesis change. A whole point of view change for the company. Now it's down 40% after earnings. So this is what happens when I see companies drop 15% plus. It is an indication that investors are losing a lot of optimism about a company. They're having an entire thesis change. And I want to dive in and see if this is the appropriate reaction from Estee Lauder. Now again, the stock right now is down around minus 15% on the day. It was down a little bit over 20%. So there has been some dip buying, people taking advantage of this. Let's go ahead and take a look at the actual quarterly results to see what's going on with this company. We have the highlights right here. They say that net sales decreased 12% and diluted earnings per share declined 72% to 43 cents. So the diluted earnings per share is very volatile quarter over quarter, but seeing that substantial of a decline is not something that's welcome news. And then even worse, seeing net sales decline 12% is less welcome news. Right now, the economy, at least in the US, is going really well. So seeing a company decline is not something we want to see. And this is where we get to the big news here. This is what's really impacting the business and I think causing investors to second guess this stock. The overall results impacted by slower Asia travel retail recovery, while nearly all markets delivered net sales growth ahead of expectation. So they're acknowledging there that there's slower Asia travel, making it so people are in the retail shops in airports and different places where Estee Lauder sells. They're there less frequently. There's less travel going on in Asia. They say lowering the full year outlook to reflect a more gradual recovery in the Asia travel retail market. So Estee Lauder does a lot of its business in Asia, and it's dependent on the travel industry in Asia. That's where a lot of their exposure is. They're in the US as well, but that's actually a minority of their business. They sell a lot outside of it. Now, to give this some context of how much exposure they have outside of the US, we can go back to Qualtrim here, and we go over the revenue chart. On the revenue chart, we have the total revenue by quarter. Then we can look at it by product. We can look at that later. But then we have a geography breakdown for some companies. Now, this isn't always perfect because they report different ways, but on this company, we can see a clear breakdown in the Americas. That makes up a good portion of their business. But then we have Asia Pacific. Then we have Europe, and I believe that's the Middle East and Africa, EMEA, Europe, Middle East, and Africa. So we have these three different segments. But notice how Asia is a huge part of their revenue. It's actually over 1/3 of their revenue. The US, Americas, is actually a smaller percentage of their revenue. So this company is heavily reliant on the economy outside of the US. And that's something I really don't like. I don't like how much of Estee Lauder's company is reliant on economies outside of the US. In the US, I have a good feeling for our regulations. I know how our economy works. I know how our government works. I know that we're the Federal Reserve. I know how we handle recessions. I understand the economy here, and I think it's a very, very overall good place for business. That's my view on the US. Business is open in the US. There's a lot of things happening here. If we compare Estee Lauder's results and the slowdown in Asia travel to what's going on in the US, I'll give you just a quick comparison here. I listened to Vici's earnings report, which Vici owns a lot of real estate in Vegas. And Vici noted that business is booming in Vegas more than ever in the history of the country. In fact, Reed Airport, which is the Vegas airport, had its highest February passenger count in history, with well over 4 million travelers in a single month. That's what's going on in Vegas. Things are open. Business is booming. Travel's booming. Then we go to Estee Lauder. and there's a slowdown and more gradual growth, and they still have restrictions. And I don't know what they're doing over there to the same extent that I know what's going on over here. So if you're considering buying the dip in Estee Lauder, just know that they do a lot of business outside of the US. Now, this is a company that's been in the portfolio for a long period of time. I've owned this one since the very beginning. In fact, my first buy of Estee Lauder was January 2nd, 2018. January 2nd, 2018, I bought $200 of it. I wish I had bought more because the price of it was $127, and now it's trading at $209. So it's had some good gains since 2018, but I want to look at the company through a fresh pair of eyes. I really want to look at it as if I don't own it, as if I'm going in and deciding whether to buy more of it in this dip. So let's go ahead and just take a look at some of the fundamentals here and get an idea of what Estee Lauder is. The company, first of all, is a beauty company, but it's in a couple main categories. They don't have a lot of hair care. The hair care is the blue. There's not a lot of hair care here. It's mostly fragrance, which is the yellow. Then we have the pink, which is makeup. This is their biggest category. It's actually growing into skincare. So skincare right now is their biggest category. Then they have some other tiny segments, products and other services. It's barely a sliver. Not much outside of that. The main company segment is skincare, and then you have makeup, fragrance, and then the small segment is hair care. That is Estee Lauder. Now, we look at the total revenue growth of the company over the past 10 or 20 years. It's growing at a speed of 6 to 10%. When I look at revenue growth of a high quality compounder, I think 6 to 10% growth is just fine. It'd be nice if it could be 20%, but for these type of companies, slow and steady growth leads to very good results because they don't need to grow their revenue to grow their earnings at a faster speed than 6%. So let's go ahead and take a look at their earnings and their free cash flow. We'll look at the earnings first. The earnings are growing at double the speed of their revenue. So even though they're growing their revenue around 6%, the earnings are growing around 12% per year. We look at the free cash flow, and this is the chart that's my favorite overall. Free cash flow is what allows a company to invest in things. It's what allows companies to pay off debt. It's what allows companies to do buybacks. It's what allows companies to raise their dividend. It all is a result of growing free cash flows. So when I look at the main metric I'm looking for, when I'm scanning over my watch list and doing analysis on companies, I always come back to the cash flows of the company and I try to identify the economics and long-term trends of the cash flows. In the case of Estee Lauder, the free cash flow has grown at a rate of 10.97% over the past 10 years. That's very fast. 11% free cash flow growth is great. Now, one thing that I do that a lot of other analysis websites and a lot of other analysts don't do is I look at the stock-based compensation. I would recommend everybody does this because stock-based compensation is equivalent value to cash. If I pay an employee $1 worth of stock or $1 worth of USD, they're both worth $1. It is payment that's going to the employee from the company. So we can look here and look at the amount of stock-based compensation that Estee Lauder does. It's a meaningful amount. It's not nothing, but it's also not an incredibly high amount of stock-based compensation. We have another chart here on this new version of Qualtrim that nets it out, and we can see the results of growth. Estee Lauder is actually growing their net adjusted free cash flow, which is free cash flow minus stock-based comp at a faster speed, it just means that their free cash flow is continuing to grow while their stock-based compensation is growing at a slower rate. So they're actually growing their net free cash flow at a faster speed. Now, this isn't where I stop. If you want to do further analysis on the cash flows of a company, there's two other charts that I think are important. We have the free cash flow per share, and this one's really a really cool chart. I want to change the color from red because it looks like it's bad, but this is actually a good metric. The free cash flow per share, which is exactly like the name implies, it's how much free cash flow the company's generating per diluted share, is growing at 12% over the past 10 years. And 2021, if we were on that year, it would have been a lot faster. So this is on a little bit of an off year. It's not perfect every year. I'd say on average, it's probably even a little bit higher, maybe 13 or 14%. But again, this metric doesn't factor in stock-based compensation. So we have the adjusted free cash flow per share, which is the free cash flow per share minus out the stock-based compensation per share. And we get 12% growth for the past 10 years. So the stock-based compensation, it doesn't eat away that much of the company. And this adjusted free cash flow per share, which I believe is a huge intrinsic value indication of the company. As this grows, the intrinsic value of the company grows, almost in line, especially if the growth is stable and has endurance. As long as the growth here can endure, the intrinsic value has grown of the company. Having a company like this continually grow its free cash flow per share at 12% is great. This is a compounder, and it looks like they're able to endure it. Even on a slow quarter like this quarter or this year, it's going down. Their guidance is going down a little bit. Their net income was down 10%, so it's going to have some volatility, but they're not dropping 50%. The company's not in desperation. It's still on track overall. So we have a free cash flow growth profile that I think is really good. It's not the best, and it's not the best in my portfolio currently. For example, we can again look at this. It's growing its adjusted free cash flow per share at 12% over the past 10 years. That's the number from 2022. Let's take a look at MasterCard. This is one of the companies that I bought into heavily. This one is growing its adjusted free cash flow per share by 17%. And it's growing at an even steadier cadence. It has a better history of keeping it more stable. So it's growing faster and it has more stable growth. We can look at SPGI, S&P Global. This company is growing its free cash flow adjusted free cash flow per share at 14%. And this is during an off year. This is when the credit rating industry is doing poorly. When this recovers, I believe that this speed will increase dramatically. We even have companies like Texas Roadhouse. This restaurant company is a free cash flow per share grower. In the past decade, it's grown its adjusted free cash flow per share at 17.35%. And I think that it's going to post good results, but we'll have to see tomorrow. So comparatively speaking, I would rate Estee Lauder's growth as really good, but not the absolute best. I think that it's better than 90% of companies, but there's still a few companies that I've tried to look at that I think are a bit better than Estee Lauder. So economically and qualitatively with Estee Lauder, it's a great company. It remains a great company even after this quarterly result. And I see nothing in this report that makes me believe that there's a huge thesis change, that the company fundamentally has changed. This result was just a minor slowdown, some cyclicality in the business, and some exposure to some markets that are recovering far slower than the US. That's it. Just a little bit of cyclicality. So to the long-term investor, I think this is a fine entry point for the company. It has a 3% free cash flow yield. It's probably going to continue to grow earnings and do buybacks and pay growing dividends over time. I don't see any real concerns here. This is nothing like Chegg reporting that ChatGPT is suddenly crushing its business. This is nothing like that. So overall, if you've been looking at an entry point for this company, I think now's the time. And if you're wanting to buy a little bit of the dip, I also think it's a great time. Estee Lauder is going to be fine in the long run. They do face some competition, but they face competition for decades. They know how to deal with it. Now, moving on from Estee Lauder, we also have Starbucks report. They reported yesterday after market close, and Starbucks smashes comparable sales estimates on broad strength across the regions. They smashed their comparable sales. They beat on the top line and the bottom line, and they reaffirmed guidance. About as strong as a report as you can get across the board. Starbucks really nailed everything. And you think after something like this, the stock is going to pop 5 to 10%. And then we look at the stock price today, and it's down almost 9%. What gives? What happened to cause investors to read this report and want to sell out of the company? This is why I say it's not that instructive to look at the immediate trading after hours. It doesn't inform you on how the company's doing. It informs you on what investors are doing, whether they're buying and selling, but not on how the company's doing. Now, I have Starbucks' earnings report pulled up here, and I want to go over some of the highlights. First of all, they outlined that their revenue growth was 14%. 14% revenue growth is fast. That's fast on any measurement, but for Starbucks, that's great revenue growth, faster than most companies. Their same-store sales were up 11% globally. Now, if you're doing analysis on restaurants, there's a couple key indicators you look for. You look for how many new locations the restaurant is opening up, and then what their same-store sales are. So they open up new locations, and they grow their sales on the existing locations year over year. And that overall adds up to the revenue growth and the earnings growth of the company. And in this case, Starbucks is doing both of these at a rapid speed, growing their revenue 14%, growing their comparable same-store sales 11%. And then we have the earnings here. The earnings per share were 79 cents. That is over what the market was expecting. So they beat the analyst estimates. And then we also have something that's a little bit unique to Starbucks, but a lot of quick service restaurants do this. The active Starbucks reward membership reached 30.8 million, up 15% year over year. Now, Starbucks has 30 million members, which they preload a lot of money onto the app to get more rewards. Starbucks uses that money that's on the app to do investments. So Starbucks has constructed a way to have a 0% interest rate margin loan of billions of dollars that they can use for investments. It is genius. What they did is so smart that it's being copied by basically every other food chain. Dutch Bros, all of these companies, they're copying this members reward program and uploading the money onto it because it's such a genius invention that Starbucks did. It's like they're running a better version of a bank. They lowered their cost of capital and they further locked in customers' future purchases. So this result from Starbucks is very strong result, and the same thing financially. I've gone through their free cash flow calculations, their earnings. It all looks very much on pace, a very strong result from the company, and not a result that's deserving of an 8% sell-off. This is not reflective of the financial or performance of Starbucks. If I had to speculate of why investors are selling out of the company right now, I think it's a combination of two things. First of all, the price of Starbucks is a little bit high. It's at a 34 PE ratio, which is above most companies. So it trades at a higher valuation, and I think that investors are doing some gain taking. I think they've made a lot of money over the past 6 months. Just a few months ago, Starbucks was trading at $70 per share. Then it raced up to $115. So you had some really good gains there, 40% gains. And a lot of investors are going, well, I made my gains. The company's doing really well. Time to take some of those gains and deploy it into better opportunities. That is precisely what I did with my Starbucks position. I used to have at one point in time around 20,000 invested in this company. Right now, I only have 3,700. I was buying into Starbucks around $70 to $90 per share during the time period where everybody was concerned about the unionization. They're concerned about the leadership of Starbucks and the CEO coming back. A lot of confusing things, a lot of negative sentiment, and now the sentiment has turned positive. The price has gone up, and I think that there's some investors just taking gains. And I do not believe that this 9% red day today for Starbucks is at all reflective of the company's performance. I think it's heavily disjointed. The stock price is going down while the company Starbucks is doing phenomenal. They're executing everywhere they can. They're raising guidance. They have incredible brand recognition. They have pricing power. They have ample room for growth. I think the company's in as good position as it's ever been. So in my opinion, if I was looking for which company I was going to buy the dip on today, the 9% down in Starbucks or Estee Lauder being down 14%, I think either of them you'd be fine. I would be fine buying more of either of them, but I'd probably lean towards Starbucks more. I like the positioning competitively of the company. I like their growth prospects, and I really like that they're raising guidance, not lowering it. So there's my thoughts on both Estee Lauder and Starbucks. I hope this video was helpful. If it was, make sure you subscribe to the channel, and I'll see you in the next one.